Britain's economy bounced back to grow by 0.7% in the second quarter of 2015, according to official figures released today. So what does this mean for the economy and for the Bank of England's planned interest rate hike? I'm joined by Danielle Haralambous, editor and economist with the Economist Intelligence Unit, to find out. So Danielle, the 0.7% GDP increase between April and June was broadly in line with expectations, meaning that the Bank of England isn't likely to rush into raising interest rates earlier than expected. Are there any other indicators which could hinder expectations?
Yeah, this was in line with the bank's expectations as well as the markets. The bank expects another 0.7% increase in the third quarter. Based on this kind of quarterly growth, Mark Carney, the governor of the bank, says that the output gap in the UK is likely to close within the next year. Now, to us, this suggests that the first rate increase will arrive at the beginning of 2016 because the bank is likely to want to move to tighten policy before the output gap is fully closed to reduce the chance that inflation doesn't overshoot. And it's going to accelerate in the second half of the year as spare capacity is eroded and the impact of last year's oil price rise falls out of the annual comparison. But in terms of other indicators, pay growth has also picked up, although there's some uncertainty about how durable that increase will be. At the same time, there are a few factors that suggest that the bank rushed to tighten policy. For example, UK households are highly leveraged. House price inflation is still supporting growth, over-reliant on it. And the steady appreciation of sterling over the past 2 years has already represented a form of monetary tightening. There's also heightened risk from events in Greece and financial market volatility in China that add to the case for waiting to tighten policy.
You've touched on a few there, but today's GDP figures also confirmed some of the ills that have affected the economy for a while. Manufacturing seems to be struggling, while construction remains relatively flat. How does it look going ahead?
Well, service sector growth has continued. Yes, manufacturing output contracted, and although the broad production category, which manufacturing features, though that broad category increased by 1%, but really that jump was down to the mining and quarrying output sector, which doesn't look likely to be sustained. It was quite a significant jump. So really this shows that the service sector continues to account for all growth in the economy and that the recovery remains unbalanced. Still, the economy has rebounded from a weak performance in the first quarter when it was 0.4% growth. The data is subject to revision, so we might not want to read too much into it at this stage, but the pickup in momentum at the beginning of the year is encouraging, certainly relative to the pace of recovery in Europe. For UK, real GDP is now 5.2% larger than the pre-crisis peak at the beginning of 2008, while for the Eurozone economy, it's still 1.5% smaller.
The strength of the pound has also seen factories grapple with weak exports going into the second quarter. Do we need to be cautious about GDP?
We'll need to wait for the second estimate of GDP to find out how exports have performed, but net exports placed a significant drag on growth in the first quarter, and PMI survey data for June already suggests that they'll remain weak in the second quarter. In contrast to the surveys measuring a decent performance in services and construction, the manufacturing survey weakened to something like a 26-month low, and this was largely because of subdued foreign demand. So this really gives us reasons to be cautious about the durability of the current recovery. Just to provide a figure to demonstrate the lack of economic rebalancing that we've seen in the post-crisis period, production output remains around 10% below pre-crisis levels, while service sector output is around just under 10% above it. More broadly, we think UK growth will remain heavily reliant on household consumption, which masks deeper structural imbalances such as weak productivity and a substantial current account deficit.
Sadly, that's all from Danielle and myself for now. Thanks for tuning in. For more analysis like this, make sure you keep clicking back to Dukascopy TV. Bye for now.